let's look at this, and then maybe you can get closer and just have a frontal view of this big picture. So I got this thanks to Nedgroup Investments, but it's a powerful reminder for any person who wants to invest and invest for long term, how you should consider and look at the long-term returns. So this is very important. Me as someone with actual background, this constant reminds me how I should invest and how I advise clients to invest. If you look at the long term, here it was actually this whole chart is almost 100 years of history from 1925 to up to the end of 2019. So almost 100 years history. And over those times, and there's markets up and down and that. But then if you look at the different categories of assets, it showed that amazingly that South African equity was actually the best performer over this 100 years with an annualized return of 13.9%. And they're followed by global equity of 13%, and then high equity funds, or what we call the multi-asset prudential fund, balance fund, that was 12.6%. Then low equity fund of 10.5%, and global bonds and the South African bonds not doing too badly, 7.9% over that period. And the US cash 7.6% essentially is about interest, but also about the rand depreciation that meant the US cash return of 7.6%. South African cash, if you just leave your money in the bank, maybe in a fixed deposit, the average is 6.6%. And inflation in South Africa over this long period of time was 5.8%. And so the base scenario would always be the inflation. When you have your money and when you invest your money or you put it in the bank account, you must make sure your money always must keep up with inflation. Otherwise, you are actually over long term, you're getting poorer because your money is shrinking in value or the purchasing power. So this is a very powerful chart to illustrate to anyone or any client or investor. Notably, you can see that although the equity market has got ups and downs, and the most recent was last year, which is not shown in this chart, but then prior to that was 2008-2009 financial crisis of the world. But despite all the crises that happened, the wars and the financial crisis or the COVID crisis, etc., the equities still generate the best returns over the long term. All right, so if an investor wants to use the power of compound interest over the long term, then certainly they need to have the money in growth assets, as we speak, in equities. And over the most recent 10 years, then certainly the global equity has outperformed South African equity. And given the economic, social, and political issues in South Africa, an investor would do well to invest more in global equity over the long term. So that's a very powerful chart to remind anyone. And so sometimes I have clients, and actually a lot of times investors, young and old, that tell me, no, they don't want to be risky, they don't want to lose money, and they don't want to be in equities because ups and downs, they think that because of the world economy, what's happening, that they think they'd rather just be safe and put money in the bank. But if you look at this very powerfully, the only way a person can create and generate wealth or keep their money safe over the long term is actually in equities. All right, so have a high exposure in equity, especially global equity. I think is very important for any investor at this day and age, at any time. Until next time, bye.